Welcome to the Introduction to Lease Options module. The information presented here is part of the financing course and is aimed at helping you know more creative ways to obtain and move property. At this point in your path to success as a real estate investor, you should have researched and selected your 4 specific target markets, have gained a thorough understanding of the common terms and techniques used in real estate, as well as have achieved an understanding of how to find, evaluate, and make offers on properties. Now, as you evaluate properties, one of the biggest considerations you need to take into account is your plan for entering and exiting the property. Through the course of the lessons, you have been introduced to 3 main categories of investment strategies: fast cash, cash flow, and buy and hold, that you can use to obtain and make money from a property. However, this lesson will focus on a specific cash flow strategy called lease options. What you should know. Before beginning this module, you should understand the following basic principles and terminology used in real estate investing. Which properties to look for and why. Where to buy real estate. How to locate motivated sellers. How to perform income property analysis. Basics of the 3 investment strategies. What you will learn. This module meets the following learning objectives: understand what lease options are. List the pros and cons of lease options. Identify ideal sellers and buyers for a lease option. Identify an ideal property for a lease option. Identify lease and option agreement clauses. Understand how to market for lease options. Tips for success. Here are some tips that will make being successful with lease options significantly easier. Tip number 1. Include everything in writing. Make sure that you write all the terms and conditions of the lease option clearly so that each party understands their role in the transaction. Obtain signatures and dates on each pertinent document to help protect you and your assets if a misunderstanding occurs. Tip number 2. Use separate contracts. For each lease option you are involved in, make sure you use separate documents for the 2 parts of the transaction. That is to say, you should have a lease agreement that details the rental aspect of the deal, and a separate option agreement for the buying aspect. You will learn why this is important in this lesson. Tip number 3. Understand local laws. Many states have passed laws that govern certain aspects of how a lease option may be performed in the state. You need to make sure you understand these laws to avoid any potential fees or penalties. Also, you need to know that everything you are doing is legal so it can be held valid and lawful if there is ever a legal challenge. Additionally, you need to know the landlord/tenant laws that govern the area of the property. Since your potential buyer is technically considered a renter until they make the purchase, those landlord-tenant laws apply to you. Tip number 4. Define responsibilities. Make sure that each party understands what maintenance and repairs they are responsible for. One of the best things about lease options, aside from the income, is that you get the benefits of being a landlord without being a landlord. That means you should not receive calls at 3 a.m. demanding you rush over to fix a commode. So make sure you spell out very clearly who is responsible for what and how much cost could be involved. What is a lease option? Lease options are fairly common in the real estate world, though depending on where you live, you may not have heard of them as such. Some people prefer to call them lease purchases, while others commonly use simply rent-to-own properties. There are other less widely used names, but they all describe essentially the same process, that of a buyer securing the right to purchase a property at a later date, in exchange for a small down payment and monthly payments that are similar to rent. Any variations the different terms include are typically associated with rent credits and how those credits are given. However, for the purposes of this lesson, the term lease option will refer to the general technique and specific terms will only be used to describe unique characteristics of the general technique. A lease option, then, is an investment strategy in which a property owner leases their property to a tenant in exchange for a small sum of money up front and then a specific monthly rent over a prescribed period of time. At the same time, the tenant also enters into an option agreement, which gives them the right to buy the house at the end of the lease period, typically for a predetermined price, hence the name lease option or lease, with option to buy. Lease options are part of the cash flow investment strategy because, when done correctly, the investor gets money up front, money over time, and a large lump sum at the end when the tenant buyer buys. There are many ways to use lease options to your benefit, and this lesson will explain those techniques for you. As you learn about these techniques, you will also learn quite a bit about contracts and how to properly use them in a lease option. Advantages and challenges of lease options. Investor advantages. Buying using a lease option. One of the major misconceptions about real estate investing is that you as an investor need to have a lot of money on hand and a stable job with good credit to be successful. As you have been shown, this simply isn't true, and it's especially untrue with regards to lease options. You see, even if you have limited funds, bad credit, a high debt-to-income ratio, or simply do not want another loan on your credit, you can buy properties using a lease option. That's because in most cases you will be able to get a seller to sell you a home with a lease option for just 1 to 3% down. That means that if you wanted to buy a $300,000 home using a lease option, you could secure it with as little as $3,000. There are numerous ways you could come up with $3,000 to buy a home. Aside from the limited amount of money required to get into the home, another benefit is that you actually have control of the home. Now, that begs the question, what does having control of the home mean? Well, it means that you will be able to take possession of the home and have the right to make modifications to it. But here's the best part. If you structure the deal well enough, you might even be able to sell your option to purchase to someone else or sublease the property and sell to someone else the option to buy. That way you have just bought a property that provides a cash flow for you, for a fraction of the property value. The reason this works lies in the general format of the option agreement. See, the option agreement is unilateral, meaning the seller is required to sell, but you are not required to buy, you have the option to buy. And if you include specific clauses in your contract that allow you to sublease the property and assign the option agreement, you have essentially made the property available to do what makes the most sense for you. This process of subleasing and assigning your option is called a sandwich lease, and will be discussed in greater detail in future lessons. Another great thing about lease options is that you can beat out most other investor offers on a property simply because you don't need to lowball the offer. In fact, in most situations, you should offer close to fair market value, and then ask them to lease option it to you. Obviously, the seller has to have a reason they would want to lease option to you, but there are plenty of sellers who will. Protecting your lease option when you buy. When you buy using a lease option, how do you protect your interest in the property? For example, what if the seller holding your lease option dies and the property heirs don't honor the contract? You could lose a lot of money if that happened. So, here are a few quick tips for how to protect your interest when you are buying a property using a lease option. 1. Record the option or memorandum of interest. If your option is signed before a notary, you can record your option in the public real estate records. This makes your interest in the property public, which can be beneficial if there are contract problems. However, keep in mind that recording your option does not create a lien on the property, it only creates a cloud on the title. So the seller can still sell to someone else, but if the new buyer does their homework on the property, they should be a little wary of buying because of the cloud. 2. Escrow the deed or quit-claim deed. As morbid as it may sound, if your seller has died or disappeared, you will have a big problem getting them to sign the deed over to you. Therefore, an escrow should be created up front in which a title company or attorney holds an executed deed. 3. Transfer your rights into a trust. As another method of protecting your option, you might consider having an attorney set up a trust that identifies who has rights to what and under what circumstances, and transfers the property into the trust. Whatever method or methods you choose, if you are buying using a lease option, you should make sure and protect your interest in the property as best you can in the event of unforeseen problems. On the other hand, if you are selling using a lease option, you should be cautious letting your tenant buyer record the option or escrowing the deed. Letting them do so can lead certain states to view the deal as an equitable title transaction. So make sure you are aware of your state's laws concerning equitable title. You will learn more about how to avoid this later in this lesson. Investor advantages: selling using a lease option. Lease options don't just benefit you as a buyer, there are a lot of advantages when you use lease options to sell your properties as well. One of the biggest advantages is that no matter what the economy is like, you always have a market that benefits from a lease option. There will always be people who are credit challenged, who would like to have time to save up a down payment or resolve credit issues so they can buy a home. Another great benefit is, of course, the money. With a lease option, you receive a lump sum up front and then again when the option is exercised. But in addition, if you calculate the numbers correctly, you should have a great positive cash flow each month, and you get that cash flow without being a landlord. Remember, the tenant is responsible for fix-ups and repairs, so you don't have to worry about those calls at 3 a.m. to come unplug a commode. Also, if you are looking to benefit from the tax breaks that come from owning real estate, you can still benefit from them if you do lease options. When you go to file your taxes, you can depreciate the property because it is considered a rental until the option is exercised. This is something you should discuss in more detail with your tax advisor, but in essence, depreciation is an income tax deduction that allows you to recover the cost of wear and tear and natural deterioration of the property. Another benefit of lease options is in the event the tenant stops paying you. Typically, if you were receiving payments on the purchase of the home and the tenant stopped paying, you would have to go through the long and often expensive foreclosure process. But with a lease option, if the tenant stops paying and you can't work something out with them, you simply file some paperwork with the county and call your local sheriff to have them evicted. Simple as that. This is because when you sign a lease option with the tenant, you never actually have a closing. That way all records show that you are the owner, and you are certainly not going to foreclose on yourself. Speaking of closing, you don't have to worry about closing costs until you have made a bunch of money off the lease payments and the tenant is ready to exercise their option to buy. But what is even better is that the tenant may never exercise their option. In that case, you keep renting the property to them and keep making money, or negotiate a new deal with a new tenant buyer and keep making money. This is a huge financial advantage for you because you are essentially making money off of someone else's money. Another benefit that has to do with money and lease options is the fact that you can almost always get higher monthly payments using a lease option than you could with traditional renting. This is because you are offering ownership of the property. People are willing to pay more if they know they have a vested interest in what they are paying for. In fact, it is common to receive a couple $100 more from a lease option than what the current rental market is at. See, there is a cardinal rule that applies to any real estate transaction, and that is, you either get a good price or good terms. When you give someone a lease option opportunity, you are giving them great terms. Therefore, they need to be willing to sacrifice a little on price, which translates to higher monthly payments. There is one more great advantage that lease options present when selling a property. You can attract a lot more buyers, and sometimes better buyers, by offering a monthly credit toward the purchase of the home. For example, Joe investor enters into a lease option agreement with Nancy buyer to purchase a home for $250,000. Joe requires Nancy to bring $5,000 as a down payment, 2% of the purchase price. He also asks that Nancy pay $2,000 a month in rent. However, Joe tells Nancy that each month she is on time, he will apply $500 of the $2,000 a month toward the final purchase price of the home. So if after 2 years Nancy decides she wants to exercise her option and she has been on time with her payments each month, she will have accrued a $12,000 credit for the home. That credit combined with her initial $5,000 equals $17,000 off the purchase price of the home. And Nancy has been in possession of the house the whole time. See the benefits for both parties? Joe makes great money and Nancy builds credit and equity without ever having to get a loan. Investor challenges: selling using a lease option. While lease options have many considerable benefits, unfortunately they are not without their challenges. One of the biggest challenges arises if the property sits vacant. It is unusual for a lease option property to sit vacant for any length of time, but when it does, that does not exclude you from making payments on the property whether you purchased it or are lease optioning it from someone else. Additionally, while there are many tax breaks to lease optioning, if the property is vacant, you still have to pay the taxes. Another potential challenge is the fact that you can't control market conditions, and the change in market conditions could cause you to lose out on potential profit. For example, assume you create a lease agreement and agree to have the tenant in the home for 2 years before they can exercise their option. Well, in those 2 years, home prices in the area might stay the same, go up, or drop. If they stay the same, then the purchase price established when the agreement was signed will probably be fair to both parties. If home prices drop, then the purchase price will work in your favor. But if prices experience a significant increase, then you may end up selling your property for less than market value, thus missing out on some potential profit. You will still make money, but it may not be as much as you could have made. You also may face challenges if you get a bad tenant buyer. That is to say, you may have someone who trashes the property, then leaves without exercising their option to buy. Now you are stuck with a property that needs repairs and no current income from it. One factor that offsets this challenge is the fact that you required a down payment that should cover any repair expenses, but that down payment could also have been profit. The last potential challenge is the fact that some states regulate lease options rather aggressively and the laws can change rather quickly and with little or no media coverage. Therefore, it is your responsibility to understand how lease options are viewed in your area, the laws that govern them, and when those laws get changed. The most common changes to the laws include the number of months the lease can be in place, phraseology in the contract's clauses, and the various disclosures required for the tenant buyer to sign. You need to adhere to any state-specific guidelines very closely, so you can avoid fines or violations. Tenant buyer advantages: buying using a lease option. Lease options not only provide many benefits to an investor, but there are several advantages for the tenant buyer too. For example, they get to try the home out before they buy it. That gives them time to see if the home suits their needs, if they like the neighborhood and schools, and if the home's condition is what they want it to be. Lease options also help people with credit or down payment problems get into homes. These people can save money for a down payment while they build equity living in and making improvements to the home. Tenants buyers have limited risk as well. If they don't like the home at the end of their lease, they can walk away. At no point are they obligated to buy the home. However, they do have an advantage here because no one else can buy the home while they have an active option on it. So there is a lot of flexibility in lease options for potential tenants buyers, and those options make lease optioning an attractive option for a lot of people. Tenant buyer challenges: buying using a lease option. Attractive as lease options may be, there are still some challenges that the tenant buyer might face. For example, if they stop paying, they will be evicted instead of being foreclosed. Eviction is typically a much faster process that does not offer them opportunities to request that their option money be returned. Therefore, they stand at risk to lose any money they have paid into the lease, including the down payment, if they violate the lease agreement. Also, when it comes time to exercise their option, the tenant buyer might face a purchase price that is higher than what the current market supports. That may cause problems when they try to obtain their own financing for the purchase. Similarly, they may not have fixed their credit, employment, or other financial problems, making it so they cannot qualify for financing when the lease ends, so they have to either renew the lease and option agreements or move out. As you can see, there are a lot of advantages as well as some challenges involved with lease options. Take the time to review each of the advantages and then weight them against the challenges to determine if lease options are a good investment strategy for you. Don't focus on the risk necessarily, because everything carries risk with it. Rather, look at some of your own strengths and weaknesses as they compare to the advantages and challenges of lease options. Contract design. Recall that lease options are created by the seller and tenant buyer agreeing to two contracts. The first is the lease agreement, and the second is a separate option agreement. It is important for you to understand the function of each agreement as well as some tips for creating them. The lease agreement. The lease agreement can be a standard rental/ease agreement that you can obtain online or through a real estate agent. For a lease option, this agreement functions just like a normal lease would, but it includes a few more clauses. Some of the most important items the lease agreement details are the length of the lease, the monthly rent amount, then end date for the lease, and any late fees that may be imposed. It should also include a description of the refundable security deposit as well as the terms and conditions of how that deposit may be refunded or reduced. The lease agreement should also specify who is responsible for what repairs and up to what amount. Typically, the tenants are responsible for anything under $500. The agreement should also make it clear that the tenant is responsible for obtaining and maintaining renter's insurance on the property. You should also make it very clear in the lease agreement that it is a lease agreement and not a mortgage. It may seem silly to specifically state that in a lease agreement, but it is important to have. Additionally, you do not want to refer to the option agreement or any option considerations or credits in the lease agreement, as such language could be taken as a mortgage agreement and not a lease. One tip to consider in terms of the duration of the lease: consider having it last from 6 months to 2 years. Now, that is a pretty big time spread, and the reason it is so big is because in some states they have laws that are very particular about lease options and equitable title. But if you keep a lease under 6 months in those states, you can usually avoid any problems. On the other hand, for states that do not have such specific laws, you should have the lease continue for 1 to 2 years so you can make good monthly cash flow and also have the flexibility to adjust rent and purchase prices according to local market trends. The option agreement. The option agreement needs to have some very specific terms and conditions detailed in it. For example, the option has to have an expiration date established where, if the option is not exercised or renewed, it becomes null and void. You should also include criteria for the option to be renewed if you decide to allow a renewal. Also, the future purchase price should be stated clearly in the option agreement, or, if you choose to base the purchase price off the future fair market value, then you need to include that as well as how that market value is to be determined. Any option considerations or credits should be explained in the option agreement as well as the amounts of each, if given. If you are going to hold the consideration and/or credit in an escrow account, you may consider including instruction about where the account will be held, who has access to it, and under what circumstances it may be accessed. If the option consideration is non-refundable, that needs to be stated as well. If there is a portion of that consideration that can be refundable, then you need to include how much and under what circumstances it can be refunded. Lastly, you need to make sure to include a statement that the property title will not be transferred to the tenant/buyer's name until the property closes. Contract mechanics. There are a few other items that may not necessarily need to be included as clauses in your agreements, but are important to consider all the same. Some of the items listed here are reiterations of clauses that should be in one of the agreements, but they are important enough they bear repeating. 1. End the lease with the option. Recall that the option agreement is a unilateral agreement, therefore, the owner is required to sell to the buyer named in the agreement, but the buyer is not required to buy, they simply have that option if they want it. Therefore, when constructing a deal, the lease term should always end when the option comes due. That way you reserve the right to either renew the lease and option if the tenant buyer does not buy, sell the property, or find a new tenant buyer. 2. Restrict subletting. It is in your best interest, as the seller, to restrict subletting in a signing of your lease and option agreements. By doing so, you can control what goes on with the property much easier, as well as track who is responsible for paying the rent and who might exercise the option. 3. Plan the option price. The price for the property when a person decides to exercise their option can be established a couple different ways. First, you can lock in the future purchase price in your option agreement. This is beneficial if you think housing prices might decline during the lease period, or you just want to be safe with a guaranteed purchase price. The idea is simply that you decide the price of the property today for when a buyer exercises their option in the future. On the other hand, if you think housing prices might go up, the second option is to leave the purchase price open and say it will be based on the current market value of the property at the time the option is exercised. Either option is a bit of a gamble since you cannot predict housing trends a year or two into the future. Sometimes you will lock in a purchase price today only to find that house prices in the area have skyrocketed during the lease agreement. Now, this is not necessarily a bad situation because you should still make some good money on the deal and you help your buyer because they get a great deal on the property. Other times you will leave the purchase price open to market prices at the end of the lease only to find that house prices have dropped, making it so you don't make near as much money as you had planned. Again, this is not terrible since you should have structured the deal to make you money during the lease, but it still isn't fun. Now, along with this, you may be wondering how real estate appreciation plays into locking in a purchase price. Well, in most areas the average appreciation rate is 3 to 9%. But if you want to lock in a purchase price, you should consider doing some investigative work in your target area to see what the appreciation trends have been over the past 10 years and then use that as your specific appreciation rate to determine your option price. 4. Don't mention rent credit in lease agreement. Another part of lease options you need to make sure is done correctly has to do with giving rent or option credits. By now you know that you can choose to give your tenant buyer monthly credit toward the purchase of the home. But this credit can only be mentioned in the option agreement. You do not want it mentioned in the lease agreement, because it might be perceived as transferring equitable title, due to the fact that the tenant buyer's rent is, at least in part, going toward paying down the principal. This potential problem is one of the main reasons you should always use two separate contracts for the lease agreement and option agreement. 5. Keep title in seller's name. One other thing that you need to check is to be sure the title remains in the seller's name until actual closing. That way there is no confusion of who actually has full control of the property. Also, it is the only way to ensure continued tax benefits for the owner. 6. Seller pays mortgage and taxes. It is essential for the seller to pay any underlying mortgage and taxes on the property. Even though the tenant buyer is paying enough in monthly rent to cover any underlying mortgage and taxes, the seller needs to continue paying them to maintain tax benefits and to avoid any equitable title issues. 7. Always require a security deposit. The lease agreement should always require a security deposit. The deposit should be a reasonable amount for the target area and should follow standard landlord-tenant laws for its refund, if the tenant buyer should move out early. The deposit helps cover the costs of any repairs in the home should the tenant buyer move out. 8. Determine repair responsibility. Repairs can be a major headache for both tenant buyer and seller. However, a good rule of thumb in a lease option is to have any minor repairs be the responsibility of the tenant buyer. Now, to make them feel more comfortable, you should put a limit to what they need to be responsible for. Typically, all repairs less than $500 will be their responsibility. All of the major repairs, or those that cost more than $500 would then be your responsibility as owner. When you have considered all of these mechanics and know how they will operate in conjunction with your goals for the property, you will maintain better overall control of the property. Avoiding equitable title. You have read a couple of times that it is best to use two separate contracts in a lease option as a means of avoiding equitable title. And while equitable title has been mentioned as well, it is important to go into more detail concerning it. Equitable title is defined as the interest held by one who has agreed to purchase, but has not yet closed a transaction, or an ownership interest held by one who does not have legal title to a property or the right to receive legal title upon performance of an obligation. Essentially, what this means is a seller is offering ownership without title transferring from the seller to the buyer until an obligation, typically a financial obligation, is fulfilled. Well, that sounds a lot like a mortgage, doesn't it? Mortgages and equitable titles are very similar, and if you are not careful, your lease option can be viewed as a transfer of equitable title. So how does equitable title even come up? Well, there are typically two ways: through the lender you use to secure the property, or through the tenant buyer taking you to court to dispute the lease option agreement. For example, assume you have a loan through a conventional lender and then do a lease option with a tenant buyer that covers your monthly mortgage. Well, when you signed the loan with the lender, they should have included a due on sale clause in the docs. That means that if they determine you have sold the property, they will call the full amount of your loan due. If your tenant buyer is not ready to exercise their option and provide you the money from the sale, well, you can see that such a situation could cause problems. The tenant buyer can also bring about an equitable title if they feel they need to take you to court to dispute the agreement you have with them. For example, if they feel their security deposit should be applied to the end purchase price and will not be reasoned with, they may decide to try and sue for that money. And while a suit like that will not directly lead to an equitable title ruling, it is possible that during the proceedings enough information will come up that the judge will rule in favor of equitable title. So the big question is, how do you make sure and avoid a potential equitable title? First, make absolutely certain you use two distinctly separate contracts, one for the lease and another for the option. Second, know how your state views lease options and the lease terms. If need be, limit your lease time to 6 months with options to renew the lease. Third, watch the language used in the agreements. For example, in the lease agreement, everything is written in terms of a lease and nothing is said of the option to purchase. The tenant buyer is strictly a tenant and you are a landlord, not a seller. Also, make sure to collect a security deposit on the lease agreement, not a down payment. Fourth, keep the title in your name until the option has been exercised and recorded. Fifth, continue paying the property taxes and insurance. Many times the decision on whether a transaction can be classified as an equitable title comes down to who is paying taxes on the property. And finally, make sure everything is in writing and the tenant buyer understands very clearly what they are agreeing to when they sign. Miscommunication is the root to many of the problems investors face, so just be sure and be clear. Option considerations and credits. You have learned that lease options can be quite beneficial for a buyer-tenant for a number of reasons. As you recall, the ability for the tenant to save up a down payment for when they exercise their option is a huge benefit. But there will be some who, despite their best efforts, simply will not be able to save a down payment. However, if you chose to allow an option consideration or a monthly credit, then you can help them save up even while you are making money on the property. But why would you do that? It is great to be altruistic and all, but does it really benefit you or help you make more money? Actually, it does. See if there are more terms offered in your lease option. You will have more people interested, thus allowing you to start making money on the property quicker. Also, if you help someone get into a great property and they are happy with how you help them, then when you are ready to lease option another property, you can ask the last people you helped to put out a good word for you. You may be surprised at how many more people will come trying to get into your property from good word-of-mouth advertising from people you have worked with. So the next question has to be, how does it work? How can I increase demand for my property by helping my tenants save for their down payment? Well, there are 3 ways really. You can offer them an upfront option consideration, you can offer them monthly option credits, or for those of you who are truly generous, you can offer both. Whichever way you choose, the money set aside should be non-refundable and should be placed in an escrow account to be applied to the purchase price if and only if the tenant exercises their option to buy. That way, if they choose not to buy, then you keep the money and find another tenant. Either way, you benefit. But what is an option consideration? Basically, it's just their down payment. But you don't want to call it a down payment because of the potential issue of equitable title that was discussed. In most cases, the option consideration is $3,000, $5,000, or 3 months of mortgage payments. However, you can ask for as much as 5% of the purchase price. The amount you require should be based on market trends in your area. If it is a more expensive market, then consider asking for a little more. But if the market is slower and less expensive, then consider asking for a little less. Just make sure the amount you require is paid up front and in full, and then placed into an escrow account before creating the option agreement. The second way to help a tenant is through giving them monthly credits towards the purchase of the home. In this case, you take about 20% of the monthly payment, rent, and apply it toward the final purchase price of the property. When determining the exact amount you will apply, make sure you do not exceed 50% of your monthly cash flow. You can also give credits both up front and monthly. If you choose to do this, you simply require a little less upfront and then take a little less from the monthly payments. Whatever way you choose to go, if you are going to offer consideration or credits, when you create your option agreement, you need to use very specific and clear language. You need to make it very clear exactly how much money is going to be applied to the purchase price of the property and that the money will only be released at closing and only if the tenant exercises their option. You may even consider having an attorney help you draw up the option agreement, or at least have an attorney review one you create. There are some important ideas here that can be very beneficial to you and to your tenants/buyers. There are also a couple ideas that might be a little hard to understand, so here is an example, start to finish, of what can be done with consideration and credits. Assume you purchase a nice single-family residence with 3 beds and 2 baths. You obtain traditional financing for the purchase and your financed amount is $100,048. Also assume that you got a great deal on the property as it has the potential to sell for $154,900 today. One of your first steps in the lease option process is to determine what the end purchase price will be if the tenant exercises their option. Well, you want the lease to extend for 2 years, so the question becomes, what could the home sell for 2 years from now? If you take an average appreciation rate of 4%, and multiply that by the home's value today, that will tell you how much the home should appreciate in a year. Add that to the current value and repeat. The final number you get tells you what the home should be worth in 2 years. Your calculation should look like this. $154,900 times 0.04 equals $6,196. $154,900 plus $6,196 equals $161,096. Then multiply by 4% again. $161,096 times 0.04 equals $6,443.84. Add that to the value after 1 year. $161,096 plus $6,443.84 equals $167,539.84. You end up knowing that the home will be worth $167,539.84 in 2 years. Now, just to show you how nice lease options can be, if you subtract the price you bought the home for, $100,048, from the value 2 years from now, $167,539.84. You get a difference of $67,491.84. Not a bad profit for one property, but this is a lease option, so your profit doesn't end there. Assume that the average rent in your area for this kind of home is $1,000. Well, since this is a lease option and you are offering terms, you can bump up the rent a little. So you decide to charge $1,100 a month in rent, just a little more than the market average. The next step, if you don't already know, is to figure what your underlying loan payment is. In this example, your financed amount is $100,048. Take that and plug it into an amortization calculator. You can find one by going to your favorite search engine and entering amortization calculator. Using a 6% interest rate amortized over 30 years and then including a bit for taxes and insurance, you get a monthly payment of $600.44. The tenant is paying $1,100 and your monthly is $600.44, leaving a monthly cash flow of $499.56 per month. That is excellent. So you have a spectacular cash flow. Now you also have some flexibility that you can offer potential tenants buyers. Say you require a non-refundable option consideration of $3,000 and you give $250 a month in credit. That puts the $3,000 in your pocket up front and keeps your monthly cash flow at $249.56. If the tenant buyer exercises their option at the end of the lease period, your total profit on this deal is $72,941.44, the total of the profit from the sale plus the monthly cash flow for 2 years. If the tenant buyer does not exercise their option, your profit continues to go up. As you can see, lease options can be very lucrative, and offering option considerations and credits can help you get more people interested. However, if you are going to consider offering considerations, credits or both, you need to make sure the property will still cash flow with the credits you are offering. Other factors you also need to consider are your insurance and/or tax payments. If you do not include them in your monthly mortgage payment, you will want to make sure you have enough cash flow coming in to cover them each month. Also, you need to account for taxes on the option consideration you receive. You will be taxed on it if it is shown as a gain. It will either be taxed when the option expires or when the option is exercised and the tenant buyer actually purchases the home. So make sure and account for that tax in your deal evaluation so it does not come as a surprise. You may consider talking to a tax professional concerning how much tax will be levied and what circumstances may exist for you to reduce the taxable amount. Finalizing the deal. There are several ways the deal on a lease option will end. However, whichever way it turns out, you will have created and solidified the lease and option contracts beforehand. There are really 3 ways a lease option might end. The tenant buyer buys before the end of the lease, the tenant buyer buys at the end of the lease, or the tenant buyer does not buy at all. All 3 options are beneficial to you if you took the time to set up everything correctly. There is nothing in the option contract that says the tenant buyer has to wait until the end of the lease to exercise their option to buy. So if, by chance, they decide to exercise that option before the end of the lease, you still come out on top. Granted, you do miss out on the monthly cash flow, but you are probably selling the house for more than the current market value, and that is always a nice thing. However, it is rare for the tenant buyer to exercise their option before the end of the lease period because more than likely they still need time to rebuild their credit or to save up a down payment. The second potentiality is that the tenant buyer buys the property at the end of the lease. Well, this is obviously a good deal for you since you benefit from the monthly cash flow as well as the end purchase price. After all, making the money over time and on the sale is one of the main reasons to enter into a lease option. The third possibility is a little more interesting. If the tenant buyer doesn't exercise their option and it expires, they have one of 2 options. They can renew their lease and option with you or they move out. Again, either way you benefit. However, many investors worry about the tenant buyer not buying or moving out, but it is actually in your best interest if they don't buy. See, once the option expires, it's gone, and now you can choose to either raise rents in the end purchase price, keep rent the same but increase the end purchase price, if you keep the same tenant buyer, or find a new tenant buyer and require a new option consideration and raise the rent and end purchase price. You can see that in any of the above circumstances, you come out on top. The property is essentially a perpetual money-making machine for you. If at any point you decide you are done with the property, then you can simply sell it outright and move on. Or, if you do need to renew or create a new lease option, if you wanted to, you could refinance the property and pull the equity out to use on other investments. If you do this, just make sure your new monthly mortgage payment remains in line with your new lease option agreement. So any way you look at it, lease options, when done correctly, can make you some great money. Marketing to get referrals. Your biggest objective in terms of marketing is to establish a buyers and sellers list. By having such a list, you do not need to spend as much of your time looking for either a buyer or seller for each deal. You already have them ready once you find the property. Understand, though, that it will take time for your marketing efforts to pay off and give you that buyers and sellers list, but once you have it, you can start to work smarter instead of harder. Imagine how nice it will be when you have motivated buyers and sellers calling you instead of you trying to find them. Now, you may be asking yourself, which marketing strategies are best? Well, it differs a little depending on where you are, but there are a couple strategies that have been proven in almost any area: posting classified ads in local and free papers as well as online, and postcards. The reason listing ads in local papers is better than in major papers is mostly because of price. Trying to post an ad regularly in the major newspaper for the area will probably be too expensive to be worth it. But as a general rule, give them a call and find out how much they charge. In fact, every newspaper you contact, you should ask them how much they charge for a classified ad, if they give any discounts for ongoing ads, and if they know when their highest readership is for the real estate section. In most cases, their best readership in general is on Friday, Saturday, and Sunday, which also typically translates into those days being the most expensive days to run ads. So if you choose to use this approach, you might consider running ads only when you have a property available to sell. A less expensive alternative is to advertise in freebie newspapers. Some examples of these papers are the Thrifty Nickel, Penny Power, Penny Pincher, and the Green Sheet. You can typically find these kinds of papers in grocery stores or automobile repair shops. Now, while the paper might be free, they usually do charge to place an ad, but in almost every case, they offer discounted rates for ongoing ads or for ads that are ongoing and appear in multiple sections. There are a lot of great resources for you to use online as well. Some of the places to list ads are free and some require you to pay to list. Those that are free may be free for a reason. They might not get many visitors and therefore not many readers. But, if it is free, it doesn't matter if you only get one response from it. You still didn't have to pay for it, so go ahead and use those free sites as well as the pay sites. If you do not know of some online classified sites, simply get online and go to your favorite search engine and enter online classifieds. You will see a huge list to evaluate and choose from. But since the internet is so vast, don't limit yourself to just online classifieds. Use some of the real estate sites you learned about in the Real Estate Basics, What to Look For lesson, as well. If you need to review that lesson to jot down the sites mentioned, certainly take the time to do so. Or you can go to your favorite search engine and search for real estate listing services, realtor websites, real estate blogs, real estate forums, or real estate networking. Regardless of where you choose to place the ads, the main objective of them is to have motivated sellers call you or to get referrals from people who know these motivated sellers. The ads. Now you know some of the places to place the ads. The bigger question becomes, what do you put in them? Well, you need to include words that will capture your audience's attention. But to capture your audience's attention, you need to know who that audience is. Typically, to get referrals, you are looking for real estate professionals, financial professionals, and landlords. The language you use in the ads should be centered on a problem their client may be having that you can solve. Some of the phrases you might consider using are: home not selling, out-of-state owner, need help making payments, reduce homeowner headaches, tired of rental property or landlording. Here are some examples of how to structure the ad as a whole. Home not selling. We can help. We pay top dollar for homes. Tired of rental property? Let us give you top dollar for your headache. Out-of-state owner? Let us buy your home and relieve your stress. Notice that the examples are rather short. The reason for that is twofold. First is because when you pay for ad space, you typically pay per word, so you need to keep it short and inexpensive. Second is because people will not take much time to read your ad, they typically are just skimming. So the shorter the better, as long as you make clear what you do and how you can help someone. Don't expect to have a home run ad the first one or two you create. Instead, understand that you will need to test the ads to see which ones perform best. To test the ads, place 2 ads in the same places and let them run for a month or so. Record how many responses you get to each ad. Whichever ad gets the most responses, take it and change one part of it and run the 2 ads again. See which one performs better and repeat. Now, it is crucial that when you change a part of an ad that you only change one part of the ad. If you change more than that, how will you know which change caused the change in responses? You won't. So only change one part of the ad at a time. By repeating this process a few times, you will have a consistently performing ad. Postcards. Sending out postcards to referring prospects can be a great way to go if your budget allows for it. Typically for referrals, you will send to the same real estate professionals, financing professionals, and landlords that you directed your ads toward. Similarly, the words and phrases you use should be similar as well, since you are looking for the same thing from each type of advertising. Also note that your postcards don't even have to be colored to be effective. In fact, sometimes you will find a handwritten card will be even more effective, and considerably cheaper. You want to set up the postcard just a bit different from the ads you run, simply because the postcard has 2 sides whereas the ad only has one. On the front of the card, or that side that is not addressed, you want to have your main message. Make it something like the examples given for the ads, but you can include a little more text as you are not getting charged per word. However, on the back of the card, or that side with the addresses, include another short message. You may consider something like, "Keep this card for future reference," or "Contact us now to see how we can help," or "Give this card to someone who needs help with their home." Try a few different ones and see which ones get the best results. If you want to use postcards and do not want to take the time to hand write them, there are a couple of options you can explore. First, if you like the idea of a handwritten card but you don't have the time or the quality handwriting to do them, you can talk to some local high school or college students and see if anyone might be interested in writing cards for you for a set amount per card. On the other hand, if you want the professional look of a printer, then simply go online and search for postcard services or postcard printers. You will have a number of them to choose from. Also, don't necessarily limit yourself to strictly postcards. You can just as easily create flyers or brochures you can send out or hand deliver to potential referral sources. You will learn more about direct marketing in later marketing lessons. One other point when it comes to looking for referrals: talk to everyone you can. You never know someone's situation, and they or someone they know might benefit immensely from your services. So make sure and let everyone you can know what you do and what you are looking for. You never know what might come up. The networking lesson of the marketing course offers other ideas for how to market to gain referrals. Marketing to find sellers. Do you have to market to find sellers? Actually, you do not, especially if you have a good referral program working for you. But marketing directly to sellers is another way to find motivated sellers and get them to call you. Also, marketing to sellers does not have to cost much. If your marketing budget is pretty small, you could just look for motivated seller ads and call on those. Your target market when looking for sellers are people who are motivated to sell, and who have equity in their home. These people might be willing to do a lease option for you so that you can turn around and lease option it to someone else. Example, a sandwich lease option. It is important that the sellers you reach for lease options have equity because you might need that equity for the sandwich lease option to work. However, equity is important for another reason too. It can help you buy the property below fair market value since the seller is not as restricted as someone would be if they had no equity. Well, what about people in foreclosure? They are motivated sellers, right? Yes, they are, but they may not have the equity you need to make a lease option deal work, so make sure and find out as you talk to the seller. You can find motivated sellers in a variety of different places, such as classified ads, online classified ads, real estate magazines, and by simply driving around neighborhoods. In the What to Look For lesson you were given quite a few places you could look to find motivated sellers. You should check these sources a couple of times a week for new listings. As you browse listings, whether they are online or printed, you want to look for the following keywords in the ad and give the person who listed it a call. Seller motivated. Reduced price. Must sell. Possible lease option, rent to own. Job transfer. Small down and monthly payments. Divorce. Relocation. Estate sale. Our loss, your gain. Notice that one of the words listed is possible lease option. If you are looking to enter a deal using a lease option, you will want to look for this phrase or possibly as something about monthly payments with a down payment. Be aware that as you call around on the ads you see, some of the people you talk to will be other investors. That isn't a bad thing as you can try to build a relationship with them and either get referrals or tips from them. You may also consider looking for sellers using other online techniques such as searching in your favorite search engine for sale by owner, or real estate for sale. You can search real estate agent sites to see if they list properties for distressed owners. Occasionally you may even run across a person using a blog to sell property. In fact, you may choose to start a blog about selling homes or the benefits of working with a real estate investor as a means of attracting people who need to sell. You can learn more about blogs and other online marketing techniques in the Marketing Yourself on the Web lesson of the marketing course. No matter which way you find the potential seller, you need to get in contact with them. Phoning them is typically your best option. When you call the sellers, try to determine their level of motivation. You should ask the same questions that were outlined in the What's It Worth lesson. As a quick reminder, here are those questions. Tell me about your home. How much are you asking? How long has your home been on the market? Why are you selling? Would you consider doing any financing? How much down / per month? Do you currently live there? These questions will help you know whether doing a lease option to buy the property is a possibility with the seller. You will find out if there is a way for you to use the lease option or sandwich lease option technique. If they seem motivated, then go through the steps outlined in the What's It Worth lesson to evaluate, calculate, and present an offer on the property. Just remember, the offer amount needs to ensure that you can make an adequate profit and monthly cash flow, so you will want to use the calculations taught in the income property analysis lesson to run the final numbers and determine the ability of the property to offer a positive cash flow. As you have learned in this lesson, there are a lot of ways to find sellers. We recommend using a combination of the ways mentioned to find motivated sellers. Marketing to find buyers. As you continue working with lease options, you will find that it's a lot easier to do lease options when you have a good buyer's list. A buyer's list for lease options is a group of people who are looking to buy a home with some sort of financing that you offer. In many cases, these buyers have specific criteria they are looking for in a home, so you'll want to get as much information about what they need in a home as you can so you can find the right property for them. You'll be able to do considerably more deals if you have a buyer's list, since you'll already have buyers lined up as soon as you find properties for them. But don't allow yourself to get complacent about your buyer's list. Revisit it often and maintain contact with your buyers to see if they have found anything or if their circumstances or needs have changed. So, how do you get a cash flow buyer's list? Well, you need to market to get and maintain a good buyer's list. Hopefully, your referral marketing will bring in buyers too. But one of the best places to market for buyers is also in the classifieds. You can follow the same suggestions given in the section about marketing to find referrals, except you should use some different phrases. To get buyers, you should use terms such as no bank qualifying, minor fixer remodeled, lease option rent to own, stop renting start owning, low down low monthly payment, bad credit okay, easy qualifying, minor fixer with equity, many houses to choose from, call for a free list. You may even consider looking at other classified ads or marketing pieces to see if you can use some of the wording in their advertising. Here are some examples of how you can phrase your ads for buyers. Why rent when you can rent to own? We can offer you options to get into a home with little money down. Bad credit or no credit okay? Call XXX. Stop paying your landlord's mortgage and start paying your own. We can help. Call XXX. Little money down gets you into a home of your own. Lease to own your own home. No banks required. We can help you get into a home today. Call XXX. Easy qualifying, small down, reasonable monthly payments. Rent to own a home today. Call XXX. If a buyer calls you, but they do not meet your buyer criteria, you might consider asking them for referrals. You can make it worth your time and theirs if you offer a referral fee for every referral they give you that completes a transaction. Typically $100 to $500 is a good amount to offer for referrals. One key thing to remember as you build your buyer's list, you want to track which mailer or ad the buyer used to find you. That way you can go back through your list of buyer leads each month and determine which marketing efforts are working and which ones are not. Then you can make the appropriate adjustments to your marketing efforts for the next month. Just like testing any other kind of ad, it's best to make one change at a time and test how the change has impacted your response rate. Over time your ad will perform better and better. Screening buyers. It would be great to have hundreds of people calling you and begging you to help them get into a home. However, there will be many people who call who, for one reason or another, you won't be able to help. Similarly, not every buyer who calls is the ideal candidate to help. So as people start calling you, there are some specific questions you should be asking them to help you know if they are a good candidate for you to work with. How many bedrooms and bathrooms do you need? How much can you put down? What are you currently paying per month? How soon are you looking to move? Which areas are you interested in? What do you do for a living? How long have you worked there? Have you tried to qualify for a loan already? What happened? The answers they provide will help you understand their needs, so you can determine if they meet your lease option criteria. If they don't meet your criteria, let them know, but do so in a polite and honest manner. But what is the criteria you should use? The next section will outline that a little better for you. Identifying an ideal seller. In the What It's Worth lesson you learned what makes a seller motivated as well as questions you should ask to determine their level of motivation. Recall from that same lesson how important it is to screen sellers based on their level of motivation. As you gain more experience in real estate, you will notice there are all kinds of different sellers. Over time, you will learn which types of sellers and their motivations match your investment criteria. For example, a person who is willing to sell using a lease option typically has a few common motivating factors in their life. Some of these factors could be that the seller is currently, or soon will be, paying 2 mortgages. Sometimes the property is an old rental that has a lot of deferred maintenance that needs to be addressed. The owner may not have money for the repairs, or they just don't want to do the needed repair work. Others will simply not need the money from the sale immediately but want to maintain the tax benefits. It could also be that they are moving to a different area far from the property and they do not want to have the headache of trying to sell it before they go or hiring someone to show it and try to sell it. These are some of the most common reasons someone will sell using a lease option, but whatever their motivation, essentially what you are looking for are people who have equity in their home and want to make money on the property quickly. Identifying an ideal property. The property profile for lease options is the same as the one that was described in the What to Look For lesson. As you should recall from that lesson, when you first start investing in real estate, you want to focus on single-family residences, SFRs. The reason SFRs are so good to focus on is because they are always in demand, and they are easier to sell or rent. Some of the property characteristics that you want to look for are detached dwellings, not condos or townhomes, with at least 3 bedrooms and 1 or more baths that are in the low to median price range for the area and located in a decent neighborhood. The property can be in great condition or require minor repairs depending on what you want to do with it and what you are able to spend on it. There are times when condos and townhomes are profitable, but since there is not as big a market for them, you should pursue them with caution. Identifying an ideal buyer. In many cases, your prospective tenant buyer has been denied conventional financing by lenders, or they may simply be accustomed to renting and don't feel comfortable trying to obtain financing to purchase. They may know they have a low credit score, high debt-to-income ratio, or a small down payment that would exclude them from traditional financing. Most often, these buyers want a home they can fix up while they rebuild their credit, save for a larger down payment or pay off some of their debt because they know there is equity potential in the property. In the lease option marketing section, you will learn the best keywords to use in advertising to attract these kinds of buyers. Through your advertising, potential tenant buyers will tell you exactly what they are looking for and why, thus allowing you to refine your personal property search criteria. Summary. In this lesson, you should have learned the basics about lease options and how to work with them. You should be able to identify some of the benefits as well as some of the challenges present with them. Also, you have enough information to begin using lease options as you are out looking for property. You know what to look for, who to look for, and what to say to someone when you get a chance to talk to them. If by chance you don't find some good lease option possibilities as you are out searching, you also know how to begin marketing to find sellers, buyers, and referrals. You have seen some examples of how profitable lease options can be as well as how to construct your agreements when setting a lease option up. So now all it takes is for you to get out and use the information you now have. Review this lesson if needed, but as soon as you can, get out there and start making money with lease options. Coming up. From here you can move on to other lessons in the lease options course that will discuss how to do sandwich lease options, and many examples of these techniques. You may consider reviewing the income property analysis lesson as well as the cash flow buyers list lesson if you need to review how to calculate offers or how to maintain a buyer's list. Also keep in mind the lucrative nature of lease options and the goals you have established for your investing career. You have the abilities, you have the knowledge, now you just need to apply it. Decide if lease options are a good fit for you, and if so, start today to see the benefits that come by using them properly. You can do it.